NDTV Profit.
Welcome back. You're watching Power Lunch. CRISIL has put out an interesting report which talks about the fact that the expected gross non-performing assets or NPAs are likely to increase sharply by 110 basis points to 4.4% of gross advances by the end of this year. This would be a sharp appreciation compared to what we saw in FY13. We have with us Pawan Agrawal, Senior Director, CRISIL Ratings, to talk about the kind of stress that the banking system is going through and the perceived deterioration in the asset quality ahead. Pawan, great having you with us. What's the kind of stress that you are looking at in the banking space right now? Where is the stress coming from and how bad is it going to become as we approach the end of the year?
I think before coming to the banking sector, I just wanted to give you a quick perspective of what we are seeing in the overall economy and the credit environment. Clearly, the study that we have put out is a compilation of the rating actions that we have taken during the first half of this year. And this reflects the ratings that we have outstanding on about 12,500 companies. These 12,500 companies represent nearly 40% of the banking system's credit outstanding, and therefore the credit quality trends that we are seeing in this is fairly representative of the asset quality trends that you will see in the banking sector. So what we have seen in the first 6 months of this year is the credit ratio, which is a relative ratio of upgrades to downgrades, has remained below 1 for now two full years. For this first half, this ratio was 0.87. Essentially, a ratio below 1 indicates that the number of upgrades is lower than the number of downgrades, and that essentially indicates that there is a pressure on the credit quality that we are witnessing in the overall environment. Now, if you deconstruct this pressure, you will see that the pressure is higher for sectors which are investment driven. So road, construction, power are the sectors where clearly there is a pressure is much higher. And if you look at on the other side, the pressure is lower on sectors which are a little less capital intensive and which are a little more consumer driven. Overall, therefore, from banking sector perspective, coming to the question you asked, what the implication of this is that the sectors where the bank debt is outstanding is where the pressure is relatively higher compared to the average, and therefore the impact on the bank's asset quality is disproportionately higher compared to the average that we see at an overall level. The numbers that you talked about in terms of gross non-performing assets, also there is another dimension that I would like to highlight. The dimension really is that we need to look at it in the context of weak assets rather than just the gross NPAs. And the weak assets essentially is the way we are looking at it and analyzing a combination of gross reported NPAs as well as a proportion of restructured advances to the extent that we believe have a risk of slippage into NPAs over the next few years. And therefore, if we look at weak assets, the overall weak assets as a percentage of standard advances proportion we expect to increase to about 5.7% by end of this year from about 4.3% at the beginning of this year.
Right. Pawan, you mentioned at the start that the credit ratio, which is the proportion of upgrades to downgrades, stands at about 0.87 times, has been below 1 for the last 2 years. Are we going to see further deterioration in the credit ratio going forward? Because whatever macro data we are getting, when we juxtapose that to the kind of stress that the banking sector is going through, one gets a sense that downgrades are the only way forward. So do we see this credit ratio worsening from here on?
I think the credit ratio will remain below 1 over the next remaining half of this year at least. And if you look at therefore the macro data, the two macro data indicators that are important is the GDP growth. Our expectation is that it will be 4.8% below what we saw last year at 5%. And more specifically within that, if you look at the industrial component of the growth, which is just going to be about 1%, which is nearly a 2-decade low. And why is the growth important and a very substantial indicator or risk for credit ratings? I think we did a study on about 2,500 companies that we rate from BBB minus and above. And in these 2,500 companies we looked at, we found that the risk to prolonged slowdown in demand came out as the highest risk. So nearly 25% of the companies that we have ratings out of this 2,500 are vulnerable to prolonged demand slowdown. And that is where this demand context from an economic perspective is important.
Right.
The second aspect equally is the liquidity. I think the weakness in the liquidity is the additional dimension that will keep some amount of downgrades pressure to remain high.
Right. You know, you mentioned liquidity. Let me take you to what has happened yesterday in the form of RBI cutting MSF rate. Do you think these measures would actually address the liquidity pressure that the system is facing right now, or it's just going to help only to some extent? Because you talk to banks, they say that we are facing tremendous shortfall. These token 50 basis point MSF rates won't really help. We need perhaps a large infusion of funds. Do you think that's a big concern right now for banks?
One part of, and I think the focus on the liquidity that I want to keep from a corporate credit quality perspective is really the stretch that they are seeing on the working capital cycle, and that working capital cycle, if you look at, we are seeing there is a clear increase in that working capital cycle. That and the impact of that is visible on the credit quality in the manner that for companies or sectors where we see gross current assets that have increased to 240 days of sales and above, there we see the pressure on downgrades. The number of downgrades is much higher. It is nearly twice the number of upgrades that we see.
Right.
So clearly the systemic liquidity only adds to the pressure that the companies are facing inherently in their business in form of working capital, and therefore the measures related to systemic liquidity are important from easing the pressure to the excess available and also to the cost of funding.
Right.
So yes, to some extent some of these measures should help the cost of funding, and to that extent it is something that will be useful.
Right. Just one final question. Does that also mean that we are going to see rating downgrades for banks also going forward if the same kind of pressure persists?
It is a likely scenario given the fact that asset quality and the profitability is likely to be weaker. But we need to also keep in mind the fact that for a lot of banks, the public sector banks especially, the cushion available in form of capital availability from banks, from the government of India, which is the parent, is equally an important determinant, and that aspect is something that is in addition to that is helping, I would say, the banks offset some of this pressure. So to the extent that the capital support expectation continues to be there will be some balancing of this pressure on the asset quality and profitability that will happen.
All right, Pawan, thank you so much for joining us for that brief discussion. Again, appreciate your time, appreciate your comments. That's Pawan Agrawal at CRISIL talking about the stress in the system, and of course the credit ratio, which is well below the 1 mark. It's actually 0.87, has been below 1 for the last 2 years, and is expected to worsen as we go from here. Bank Nifty meanwhile is close to the lowest point of the day. Optimism around the MSF rate cut hasn't really lasted. We are witnessing markets close to the lowest point of the day as well. That's a wrap on Palan, but stay with us. The action continues right here on Profit.